Hey guys, how's it going? So today we're going to talk about financial laws. And now, financial laws, in some sense, are very similar to empirical laws that we observe in the natural world, like in physics, or things like that. And it's important to recognize that we're going to treat um, basically markets. We're going to try to hold up the global financial system and look through it, peer through it as if it's like through the lens of a prism, and we'll decompose it across all the frequencies of trading. And the usefulness of thinking about the market in this way is because you can think of capital as the financial equivalent of an invariance in physics. And you can think of markets as these um, ensembles of interacting particles or assets that are all, you know, in this kind of medium. And from then on, you can think about how they evolve under thermodynamic or kinetic and relativistic laws if you go to the high frequencies. So that's kind of the usefulness of thinking about this um, is by organizing all of it into no arbitrage. Now, I'm not going to specifically go into no arbitrage specifically because that's kind of obvious, especially for, I guess, my audience who understands that no arbitrage is not necessarily a law, but it's more so an invariant, and it's something that is it gets achieved by means of different edges in the market, and alpha is getting arbitraged away, and the price itself tends to settle such that there is no arbitrage when the market is working the way that it should. And so, you know, counting frictional fees and all of these things, but volatility or risk and latency, they're going to be sources of friction and irreversibility. And so we're going to go through basically about 6 of these laws, and we're going to try to move from these types of static structures that you would find in physics with a continuity equation all the way to the relativistic types of limits. So you'll start with conservation laws. So why we would want to start with and the analogy that you can make is hydrodynamics. So capital can't be created or destroyed inside of a closed transaction, only transformed, relocated, or delayed. There's got to be some kind of settlement, right, as well. And so you'll have some way of bookkeeping assets, liabilities, and equity as this kind of shadow of the continuity law itself. So you'll take essentially some capital density. So you can think of, and this is more abstract. So we're going to treat this more as kind of a financial, like we're going to try to derive it from like a physical standpoint using like physical reasoning. And then we'll translate to what this actually means in terms of the Federal Reserve's balance sheet. And so the flux from the capital density, um, we can think of this as repurchasing market flows and credit extension. And we can define an equation as such, where we have some kind of surface term where there's some net outflow of capital and some source density of capital. And basically, what happens is we have a central bank balance sheet expansion, and by applying the divergence theorem, we can, and shrinking the control volume, we can have the continuity equation from physics, and gives us kind of a steady state network flow equation that solves basically everyday payment and settlement systems. And there's also a mechanism in finance that we call the rehypothecation multiplier. And so if we were to pledge some collateral, let's say we have some, because we have both the liability and the equity. Let's say we have an asset, like if treasury or something, and we're going to pledge that on a repurchasing market. Let's say we're I don't know, JP Morgan, right? Or let's say we're the Fed, right? And we're making the market or we're making the repurchasing market. And we're dealing out these treasuries. And what this treasury is going to do is it's going to allow us to collateralize the treasury to get our hands on liquidity or to get our hands on US dollars in exchange for the treasury itself. Now, you can pledge, repledge, and then pledge again along with a dealer chain. And basically, there's some fraction of the collateral for reuse, and then a fraction that's withheld is something called the haircut. And the total credit that is supported is going to look like a geometric series. Now, this is exact for an infinite chain of collateralized credit and closely observed through dealer networks. I'm citing Singh's, I think this is from the paper in 2023 on the St. Louis Fed. Oh, man, I need to get better at citing. Tell you what, I'm going to put the papers to reference at the bottom at the description so that you guys can read them. But basically, when you rehypothecate, it's not new money. It's just the same row or the same capital that's just counted many times because they're being dealt out and loaned for banks, or banks are borrowing that capital for some particular rate that they promise back. And so you can have this is basically how liquidity gets passed around between banks and dealers and hedge funds. And so you basically will have some shattered liquidity that even through the base capital that never moves, and that asymmetry is a conservation law that's made visible, and it's the mechanics of an everyday liquidity crisis. Okay? Now, really, what you should remember is the double entry bookkeeping here, which essentially tells us that we have assets plus equity, liabilities plus equity. This is a nice discrete version. This is a nice discrete version of the capital conservation type of law, where capital is just inherently an invariant quantity. There's a fixed amount of it, and the Fed can only print so much on its and hold so much on its balance sheet. And then they control that. They control the volume with quantitative easing and tightening of U.S. dollars. And then there's also treasuries. We're not going to get too much into the mechanics behind that, but that's the whole point. Ideally, that's how this should work. Now, central banks really are just the source term here in the continuity equation, or in the continuity equation here. So what we can do is look at the rehypothecation multiplier, and this is so bad, but as you get margin calls, the liquidity can evaporate here, and the reuse velocity of capital as it goes up and up and up and up and up, we're going to demand the shadow liquidity multiplier is going to increase. And the reason why is because of the haircut that gets demanded for reusing the chain. And so, like pre-crisis or pre-2008, we might see a repo market be around, times 4 haircuts or something like that. Versus, as it goes up and up and up, on the reuse velocity, the collateral reuse velocity itself, it gets rehypothecated, and as you can see, 1 minus v, as v tends to go to 1, you get a blow up in the actual base cap collateral, and that causes the draining of liquidity. Okay, and then of course post-crisis it might settle down because the Fed will just fill the coffers full of US dollars and print a bunch of money for all the banks and bail them out. So Next thing that we'll have here is liquidity evaporation. Now, you can think about, this is a rough picture. This is real data, by the way. As you can see, the Fed, from having $7 trillion on its balance sheet in 2023. I think this was during the Biden administration. They started engaging in quantitative tightening, but essentially, you can think about how during this hiking cycle here, or there's a hiking cycle up, and how this shadow liquidity collapses while the base capital remains pretty stable. And you can think of this as the conservation law itself kind of in action. This is a very estimated point of and by the way, this shadow liquidity, this rehypothecation can also happen in internationally as well, like in Eurodollar type systems, where you have different ledgers that use US dollars in a different way, and this would be kind of higher order effects. But for the most part, just for argument's sake, you would see that this a particular conservation law that's happening here is still kind of in effect. You see this trade-off here, and the base capital is remaining pretty stable, but the shadow liquidity is kind of being affected. And so we're just kind of using this estimation of the shadow liquidity that we're saying, no, it's about probably $2 trillion, $3 trillion. We're using a proxy, but essentially that's how we can think about this, as just we're staying smooth while the reuse driven shadow money contracts have different stress points. Okay, and this defines a capital invariant through time. Okay, and so that's the conservation law. But now we can think about this as like a conserved fluid or liquidity of capital, and now it's going to flow into this nice one-dimensional surface. So we're going to move up into the frequency of more near equilibrium systems. So at time scales, the system will be relaxing towards equilibriums, or an equilibrium, and we can start talking about the yield curve. And the yield curve is something that is governed by an equation of state. Now, what this monetary policy itself, hold on, I need a drink. So monetary policy is going to fix the admissible states of this yield curve. And the curve's daily wiggle, it's going to live on this nice manifold, or very low dimensional manifold that we'll visualize in a second. But you can collect daily changes from the covariance of these particular yield curves, and because the covariance is symmetric, positive, or semi-definite, spectral theorem will give you an orthonormal eigenbasis, and any move will correspond into uncorrelated normal modes with variance lambda. And so we can then decompose the yield curve into these types of principal components. Now, empirically, the spectrum is very top-heavy, so the first three modes are going to explain about 99% of the variance across the decades. And this was a nice, this is an intentional, this is a kind of discovery that monetary policymakers had made and had designed it in such a way so that, if you had a nearly flat uniform shift of the whole curve, that you could think of this as a change in temperature of the entire financial system. You can also think of the slope or a monotone as a steepening or flattening of the yield curve. This is like a pressure gradient that drives capital across horizons. And then curvature, You can think of this as like a hump or a budging of the belly. People talk about this budging of the belly as this susceptibility that flares near regime boundaries. So if you ever hear these macroeconomists talk about bear, bull steepeners, or whatever, they're usually referring to these three principal components and different, behaviors of the yield curve itself. And so for a bond, pricing bonds. So for a bond with price P of y, because these particular yield curves or these financial products are bonds themselves. The second order Taylor expansion gives essentially the pricing formula for the duration, and the convexity is always positive for option-free bonds, and you'll get curvature cushion that relies, and you'll get gains that rely, that rallies exceed losses on sell-offs. This is the financial analog of positive specific heat that stabilizes the response built into the geometry itself. Blah, 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 blah. So you can see, of course, we get 90%, or about like 99.6% of all the variance explained by these three principal components, which is why it is so essential to the macroeconomic, or I guess monetary policy that influences the yield curve and its normal modes. And then the manifold itself looks like this, and we can kind of, through different weeks, look at how it evolves itself. And of course, this would be the maturity. These are the days trailing. So this is kind of a moving yield curve. Really, it would look something, if you looked at a cross section of the yield curve through time every day. But as you can see, every day it's kind of like it's a fluctuating thing near equilibrium. It's finding that equilibrium, but it's not necessarily super like dramatic, right? The changes aren't like catastrophic or all of a sudden, and so that's the whole point. It's kind of something that gradually changes through time as the days go on through 2025 all the way to 2026, where we are experiencing a lot lower rates and sort of a period of fiscal dominance versus this period of a lot of being heavy on the monetary policy. So anyways, you can just see like this kind of you can just kind of see that the shapes are this is remarkably stable across all of these years. And of course I could keep going back like from 2020 like all the way like much farther. I just don't think like that's necessary. You can take my word for it. So that's kind of financial law number 2, which is just the yield curve types of dynamics. Now let's talk about law number 3. When we start to construct ensembles of assets, right? When we have like 50 assets or something, you get genuine economic signals, but they're going to be buried in thermal noise. So a lot of the things that we have to think about when dealing with assets is some, I guess, laws for cleaning these statistical ensembles, and also we'll talk about the fundamental law of active management, which basically tells us that your skill in trading, right? The fundamental law of active management should be pretty familiar to most of the people who do finance or watch my videos that are financiers. Skill is your informational edge only becomes powerful when it's multiplied by breadth. Because if you took some your correlation between your forecast and your residual return, your skill per bet. If you took your breadth, or averaging over your independent bets, your forecast error shrinks like 1 over the square root of this. And this is just basically central limit squaring. So the achievable information ratio would be IC square root B R. And this is basically kind of like, you can think of this as like an ideal gas law of performance. Performance itself as just basically this, basically your skill per bet, or the temperature is basically your skill per bet, and your skill multiplied by some volume scaling, or some basically this is diversification, or the breadth, that has to do with or the breadth and the correlation basically of the assets, or the degree of which you're diversified in that portfolio. But breadth is only real when the bets are independent, so of course, like, the correlation will fudge it up, and so the effective breadth will saturate to IC over the square root of the correlation itself, as we take this particular form to infinity, or to find effective breadth. So correlation imposes a hard ceiling to no amount of trading, or that no amount of trading can actually beat. And of course, to use breadth, we need covariance, but in assets and only T observations in the sample, sigma hat is mostly noise, where sigma hat is a covariance matrix because it's just very noisy with a bunch of assets. So what we'll do is we'll take something from Bashad's book, and they use the Marchenko-Pasture law. And this comes from random matrix theory. It essentially just says that if you have any eigenvalue above lambda plus is statistically compatible with noise, is statistically incompatible with noise itself, it becomes a genuine factor. And so you can think to shrink the bulk back to its mean, rebuild the covariance matrix, its top eigenvectors and robust eigenportfolios, and hence, be able to punch them through this threshold one by one. And so that's what you'll kind of see here. You'll have, sorry about this weird overlap, but the noise is going to fill most of the Marchenko-Pasture distribution. And you'll have all of this, pure noise here, that comes out of the distribution. Whereas you'll actually have real factors that make it above the particular threshold. And as your eigenvalues, you'll get different eigenvalues, and these are actual genuine features that kind of make it above this particular threshold, and then you'll recreate the covariance matrix from this. So that's just kind of a demonstration. And then here's your fundamental square root law, where, if there's zero pairwise correlation, you would expect, if there's zero pairwise correlation, you would expect that this, from the independent, I guess, breadths, if it's correlated, it would become, the ceiling itself would become a lot more flat, versus if we were to just have uncorrelated, pure independent breadth, with the information, or the scaling, the fundamental law of active management would scale the way that it should. So that's just the demonstration here. Now, law number 4 is where things get interesting, because we start getting into actual physics, and diffusion and heat. So you can think about at more diffusive time scales, this would be around the trading time between a weekish, maybe even in the daily or the intraday, if you will. So weekly to intraday, you would have diffusion. And at diffusive timescales, individual trades, they're going to blur into stochastic types of processes, like geometric Brownian motion or diffusion under some real-world measure. And so it's not going to really care about pricing in the sense of the normal way that pricing happens, ideally, because we're on more of a resolved time scale. So because we're on more of a we've resolved our time scale a little further and zoomed in, we're going to see a lot more fluctuations in diffusion itself. So the statistics matters here. And the whole point of doing this is to hedge. And the reason why we want to hedge in diffusive timescales is because it's going to remove this real world drift, this probability measure, or allow us to have this instantaneously riskless portfolio. We construct something called a delta hedge portfolio and price specifically the risk itself to get rid of this drift component. And so only volatility is going to remain, and risk itself is going to be priced. Expected return is not going to be priced, however. So that's very important to recognize with the Black-Scholes PDE. But this, the Black-Scholes is essentially a model that is a backwards heat equation. And so that's essentially what happens here, is we will just substitute this particular expression by using, just stochastic calculus, Ito's lemma, using a delta hedge portfolio so that it's instantaneously riskless, and then the no arbitrage forces it to earn the risk-free rate and cancel out to yield this Black-Scholes PDE. Okay, and then also in particular you'll have the curvature of the option price itself is the holder's convexity. This has to do with essentially the realized or the profit that gets skimmed or scalped. I think people say gamma scalping. But essentially it's like you have some realized volatility and then the implied volatility that comes from the actual market. And, whichever one, whichever implied volatility, if it's lower than the realized volatility, you earn some kind of profit from it. Or if they're equal to each other, then there's no profit to be gained at all. So you kind of bet on multiple fronts. So you have, this is kind of what a call option would look like, where the call is valued through time. Let's kind of zoom in here. So you would have like a, let's see. So you'd have like a spot price, and then you'd have the tenor, or sorry, the time to expiry of that option. And of course, this is not labeled, but this should be oh yeah. This just is the call value. So essentially, as you can see, if we were to just buy an option here at some specific spot price, let's say it's 100, then the value of the option here would take on some well, typically I think it would go on for one, how many shares? Let's see, 0.6, 0.5. I mean, the numerical values are arbitrary in this case. But usually, I guess if you were to play around with like Robinhood or something, which, by the way, don't do that. They don't play around with Robinhood options. But if you were to do this, I think they allow you to leverage 100 contracts or something like that. But basically, it's just portfolio replication, right? You're basically replicating the portfolio, or you're replicating the asset in like this new type of space where we're pricing its risk itself. And so, yeah, so the value of it, as you have different, for the fair value of it, as we go further on into different timescales, you can see that we get kind of a smoothing versus this sharp kind of like it's worthless here, but the payoff for your option itself would would be much higher if you were able to replicate the underlying in such a way that your option was leveraging more than like the actual spot price of the underlying. And so that's why the value of the option keeps going up and up and up. So that's why you would hold on to it or exercise it at a really short time scale here. Over here, it's a lot more uncertain, so we don't actually know. So that's why it's flattening out. All right. And then for gamma, as you can see, if we were to put volatility higher and higher and higher, it kind of causes gamma to peak out, and it causes the rest of the surface also to be a lot more uncertain, as real volatility or unrealized volatility, realized volatility becomes a lot more, the option itself becomes a lot more speculative, and so the mathematics will adjust to do that accordingly. Now, if we have something like a volatility smile, ideally, in a market that is pretty flat, right? Let's say that the time to maturity sorry. This is time to maturity. All right. So how to think about this is reality is that volatility is not constant. And so the market is going to have these types of skews on the strike per the implied volatility. So, or on the strike versus the implied volatility. So these particular curves are important because they're usually, specifically, this would be after a crisis, right? Where you have this kind of volatility smirk, if you will, where these short dated types of options here have this downside skew, and the market is like paying up for this. They're paying up for this type of crash protection, and so because they're paying up for it, there's this implied volatility is driving up the price of the option, and so it's basically just demand. It's just buy and demand. It's oh my god, supply and demand dynamics. Wow. Because if they're demanding more of these more coverage for the option or for the underlying crashing, it's going to drive up the price, and so we need to ensure that this gets reflected in the implied volatility, what the market actually thinks. And so versus there being just this cheaper, like the market doesn't think that it's going to crash, and it's not very obvious, so these options are just much cheaper. There's not really much demand for them, and so yeah, and as the time goes on, this is how we think about it. So as the time to maturity tends to go on, where the short dated, you'll show that the short dated options have much more stronger or potent downside skew, and that the market is paying up for crash protection, so that this smile here is the fingerprint. Basically, this smile is the fingerprint of fat tails, and the jumps, that the diffusion that we have up here that we were mentioning in the statistics of how the prices are diffusing in the distribution that they follow. These are all features that can be inferred from this particular way of this particular data that we see from the market. Now finally, or second, penultimately, we have the square root market impact and Hawk's excitation. Now, we don't assume anymore that we have a smooth diffusion, but that the order book itself is going to be granular, and it's going to have a structural or a microstructural type of thing going on as this type of excitable medium. And so in this macroscopic type scale, you can think about large orders that create these concave square root law types of impacts, and these square root law type of impacts emerge from this self-exciting order flow. Okay, and basically you can model any event or trade as just a self-exciting point process where if you have a bump that's an intensity and then it relaxes, you have a control parameter as well as called a branching ratio, which is how we integrate this kernel as the expected number of children each event spawns. This model actually comes from nuclear physics as well, and chain reactions. And so that's specifically how we can think about the amplification as this rehypothecation multiplier law of 1 from law 1 that we talked about earlier. And so this kind of shows up interestingly. And empirically, markets will sit around n is equal to 0.9, where the burst dominates and endogenous activity swamps exogenous news. So it doesn't matter like if, Trump decides he's going to bomb Iran, right? The market is still kind of this statistical mess. It's clustered and it's still going to, on average, behave this way. And it's just completely independent from what's happening on the diffusive scale. So it's because a lot of it is machines, but a lot of it is human as well. So it's like half machine, half human. But yeah, and then there's also the optimal execution as well. That's something you can look into for the Almgren-Chris optimal execution. But yeah, so really, large trades, basically, the larger your trade is going to move. It's going to move the price roughly with the square root of the volume itself, and that's a very robust empirical law across markets. And so you can really see that only around the square root of, or around v is to the 1/2. This power law where we choose v to be 1/2 is basically the best fit. You'll find that empirically. Maybe it'll fluctuate, between 0.4 and 0.5, but usually that's the case. And so, this is just kinetic. You can think of this as just kinetic drag in a granular medium. So it's a type of physics, physical concept. And now we can look at the Hawk's self-exciting process versus the Poisson. So you can see if we just have some intensity that's described by mu and alpha, we can then think of these event times as having, these self-exciting clustering types of moments where they cluster together versus this memoryless type of structure where we just have rare events that are just, boop, 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 happening. But if we were to take, the branching ratio, let's say we're at about, this is usually where markets are at, which is 0.9. The branching ratio itself would look something like this. And then here, there'd be a massive branching ratio right here. But yeah, essentially that's, orders tend to cluster like this in markets, and this is just quite true. If you've ever looked at some kind of crypto market making bot or whatever, like you'll see like it just goes like kind of like a machine gun, just like like when they fill the orders and stuff. It's pretty cool to watch. Anyways, I'm being silly. But yeah, I mean this pushes the branching ratio towards, if we push it towards 1 here, you can just think of this clustering here as this 1/1 minus n amplification that we saw like in rehypothecation. So that just kind of this law 5 kind of eclipses with law 1 in that way. So yeah. Now we can look at relativistic physics, financial physics, relativistic finance. um, but basically at the highest frequencies, right? Um, at the highest frequencies, we're forced to confront the speed of light and space-time. So, and the reason why is because information itself cannot move faster than the speed of light. And so at a certain point, your arbitrage profitability is going to depend on your physical location, and like the time that it takes for a signal to reach. And also if whether you're using a microwave tower to signal or to form some kind of beam to signal from New Jersey to the Chicago exchange, or whether you're using fiber optic cables. What does that look like? So if you have different light cones, or basically you can just say, let's have some venue sit at some location in space and have a price update at some time t. A signal reaches an observer somewhere else at some time t plus, that distance divided by the effective speed of light to act on a pair of venues, because the speed of light is different in a fiber optic cable versus traveling through a microwave. If traveling through a microwave, it's pretty much just regular speed of light, but it's slower through fiber optic cable, and also there's latency. So the earliest actionable time would be the pointwise maximum. That's just the maximum between the sum of the time and of the space divided by, or the distance divided by the speed of light. And minimizing this maximum places the optimal observer at the midpoint of both the venues. So you'd want to construct a data center there for the synchronous updates to make the market way less efficient. And the edge over an observer sitting at either venue would be basically this distance here. And so the medium will fix the propagation speed, and everything goes through this. So you can think about two exchanges and two light cones. The earlier you can act on both signals is the maximum of the two arrival times. And so the optimal position would be this type of geometric midpoint here. And you can think, you can toggle between, both this microwave and this fiber optic cable as well. And this is kind of it's a very same, it gives you the exact same geometry here, because this would be your observer position, but they have very different effective speeds. And so these are actual real numbers from the Chicago Mercantile Exchange. In the Chicago, this is just the classic Chicago, New Jersey route. So let's say we have from B is New Jersey, A is Chicago, and then you have this geometric type of midpoint. You basically, this is just a 1 millisecond advantage, and that advantage itself here, or really not a, this 1 millisecond advantage here that you would calculate from this particular difference is very enormous at nanosecond timescales, where the vacuum bar is the absolute limit here, and nothing can really beat the speed of light unless we figure out, how to trade with shooting neutrinos through the earth. But even then, neutrinos do not travel faster than the speed of light, except, in fact, they travel a little slower than the speed of light, so we'd have to find some exotic matter just to, shoot stuff and I don't know, make tachyon radiation or something. I don't know. But that's what we would have to do to beat the speed of light. Otherwise, we just have, if somebody did that, they'd become very rich. They would just go back in time and just do the correct trade. um, but yeah, so you have the fiber optic cables. We have an index of refraction here versus your microwave towers, which are just basically C. So we have this discrepancy here. Now, this is kind of you can just kind of read this, but those are basically the 6 types of financial laws. And in physics, you can think the physics that's happening. A physical law is basically a financial invariant, corresponds to a financial invariant. So, you have some capital conservation, rehypothecation, yield curve, slope, curvature, the fundamental law of crap. It's like active trading or something, and then random matrix cleaning, black scholes, convexity, Hawkes, square root impact, latency, light cone. So all of these things kind of connect with each other, and so we don't just finance isn't just this construct or this social thing that's apart from nature. You can think about this as having the study of value that's conserved under thermodynamic, kinetic, and relativistic constraints. And so it becomes a very important tool for, understanding finance as a science. And because finance, in a sense, is a science with respect to the way that we are analyzing it, it becomes an important tool for resource allocation and things that the human race is actually pretty concerned with. So yeah, that's everything for today. So thank you for watching, and I'll see you guys next time.